There's a lot of disagreement right now about the financial position and the health of Credit Suisse and whether or not they're about to fail and start taking down other banks with them and causing more and more problems. So I'm going to settle the debate for you and give you the answer on exactly the position that Credit Suisse is in right now and what people should be concerned about, how far things might go before somebody like a central bank steps in. Ready? Let's dive in. Markets just got absolutely rocked all around the world, depending on the sector in the industry, whether you're looking at bonds or precious metals or stocks. We had some major volatility with some assets moving up a ton, some assets moving down a ton, and the major news was this Credit Suisse potential default and bankruptcy and collapse. But as we can see by looking at their chart, the problems that Credit Suisse has had, in fact, as recently as 2014 and 2015, they were trading at around $28 a share, whereas now they're trading at around $4 a share. Their stock price is down just about 60% this year alone. Now, because of the problems that they've been facing from a number of things like bad investments and interest rate risks, the CEO came out and tried to give a little pep talk to investors. Didn't turn out too well. In fact, in a Friday memo, the CEO corner, when he sought to reassure employees, instead, the shares fell to a new record low. And the things that are being focused on that are in question with regards to Credit Suisse are the bank's liquidity and capital strength, causing Citigroup analysts to say that Credit Suisse is a buy for the brave at these levels, with at one point the swaps pricing in a roughly 23% chance of default on its bonds within the next 5 years. So what's the backstory and how did we get here? Well, basically, everybody is going to invest in one of two things. You're going to invest in risk assets or you're going to invest in safety assets. Those are the two things. One thing that's more risky, geared for growth. One thing that's more conservative, geared for, a rainy day. Now, with most individuals, is going to look like something like the old and outdated and broken 60-40 stock and bond portfolio, which we know this year has done absolutely horribly as bond prices have collapsed from interest rates going up and stock prices have collapsed as well. So the thing that you were investing in for growth is now in the toilet, and the thing you were investing in for safety is also in the toilet. Now, obviously for banks, the instruments being used are going to be different and the structures being used are going to be a lot more complicated. However, it's going to be basically the same idea. You're going to have some risky assets and then some conservative assets. In terms of those safe assets, the rising interest rate environment around the world have made it extremely difficult for banks like Credit Suisse. Now, if some losses on some investments were the end of the story, it would be no big deal. But the key thing here, especially with banks, is leverage. If we take a look at this chart from goldmoney.com, we can see the GSIB equity gearing of major banks, these globally systemically important banks around the world. The asset to equity ratio listed here is the ratio between the liquidation value of all of the assets that these banks have compared to the market cap of their company. The lower this number, the healthier or less risky the bank's assets to equity ratio is, and the higher the number, the worse, potentially more dangerous position the bank is in. As you can see in the bottom right, Credit Suisse is sitting around 17. Now, compared to some of its peers, especially in the Eurozone, 17 looks pretty good. But if we look at the US in the top left and China in the bottom left, we can see asset to equity ratios are much healthier. Now, there's two things going on here. One thing is what should happen, like what would happen in a free market. And then the other thing is what will probably happen given the fact that there are these things called central banks that organize bailouts and back up their own banks from failing. Think of it this way. Let's go back in time to the Wild West when there were these things called banks that stored gold and issued paper that said redeemable on demand to the bearer, paid in gold coin. Now let's just say everybody in town thought, hey, there's probably not actually enough gold in the bank for all of us to go redeem our receipts at the same time. And so everybody lines up and says, me first, give me my gold. Well, if the banker at that time comes out with a statement and says, trust me, there's no issue here. Nobody has to be worried about insolvency or me not having it. And just so that I can prove it, I'll redeem any receipts that you guys ask for. Well, at least the first few people in line are gonna call his bluff. And that's exactly what's happening here with Credit Suisse. These troubles are encouraging companies, investors, and savers to do more business at banks with stronger balance sheets and more stable business models. And that's exactly how things are supposed to work. However, what would happen if everybody in line redeeming their paper for gold starts to get their gold? And they see in the vault and they see, hey, the gold has run out, but somehow somebody keeps on delivering more and more gold to the bank every time a new customer asks for their gold. And you go and ask them, you say, hey, who are you and why are you redeeming this gold for this bank? And they say, well, we're the central bank. We're here to backstop the banks to make sure that bank runs don't need to happen and to make sure that banks don't fail. Well, suddenly the bank run will stop because then everybody will realize, well, I can come back at any time. It doesn't matter if the bank runs out. I can come back at any time and I can get my gold. And that is also what's going on here because we see pretty clearly that most central banks around the world are going to try and get tighter until they just can't. We saw this last week with the UK when they were trying to get tighter. They were planning on starting to sell bonds, and then suddenly the cost of borrowing skyrocketed, the pensions started to get very close to going broke, and they had to reverse course and announce unlimited QE. If we just focus on what Credit Suisse's balance sheet looks like, its asset to equity gearing looks like, the health of its business, it looks pretty bad. But as we know, the banks in Eurozone look even worse. And it's because fundamentally the big money out there knows that if push comes to shove and one of these banks is actually at risk of falling over, the central bank's job is to be there to bail them out. They are a central bank. They are the bank to banks. That is what they do. Now, I've said for a year now that the thing that will cause the Fed to pivot is a failure of banks starting to fall over all around the world. I don't think this is that yet. It's possible it gets there because we're seeing things happen very quickly now with the UK and with this and with an escalation with tensions geopolitically in Eastern Europe and Russia. We could absolutely have a couple things happen here that just start knocking things over really quickly. But so far it looks to me like it's not yet happening. Further than that, let's say we do have some trouble in Europe that does spill over to the States. The banks are extremely healthy globally when you compare it to global standards. The banks in the US are much better off. Federal Reserve still has over $2 trillion in the reverse repo facility that they can push out into global debt markets at any time they want just by dropping the interest rate they're paying here. And that $2 trillion will rush out and provide instant liquidity in markets where liquidity may have been dried up. And up to this point, the Federal Reserve has not blinked. They've said we will continue to tighten until we see job losses, we see unemployment numbers go up, we see job openings come down, and inflation comes down. In the past, every single time they've pivoted before people thought they should, inflation was nowhere near where it's at right now. That's the difference this time. And here's the kicker, here's the funny part. To the extent that the market believes that the central bank to other central banks, the Federal Reserve, will pivot and will bail out the system and will stop tightening in an effort to promote financial stability, that means that the market is front-running that pivot, making conditions easier. Interest rates on the 2-year, the 10-year, the 20, and the 30 all fell as the market started to price in a greater likelihood of a future Fed pivot, which means that as the Fed is continuing to tighten, the market is acting as if the Fed is not going to continue tightening, making conditions easier, meaning, as Brent Johnson, the one who popularized the dollar milkshake theory, pointed out on Twitter earlier today, this makes the Fed's job of tightening easier. So we'll see what happens, but as it looks right now, Credit Suisse is not in imminent danger of falling over and knocking over other banks. The Swiss National Bank will be there to stop Credit Suisse from failing, and if for some reason they don't or they can't, that will spill over into other more precarious balance sheets all around Europe. with these banks that are way worse off, like Deutsche Bank, and that would spill over into the United States banks as well. But even then, if things get that far, we've still got $2 trillion in that reverse repo facility the Fed can shove out to provide emergency liquidity at any point and still be tightening. They can still sell assets off their balance sheet. They can still be raising interest rates and shove that $2 trillion out to provide an immediate liquidity, a buffer against anything that's happening. So yes, Credit Suisse is in trouble right now. No, I don't think they're going to fail. No, I don't think it will spill over into global panic. And definitely no, we are not going to see this spill over into US banks, at least anytime soon. But as always, if anything changes, you'll be the first to know. As always, thank you so much for watching. Have a great day.